$3,548. That is how much this GBPUSD long trade made me. In this video, I'm going to be giving you guys a full insight into my exact trading strategy. So my entry model, the exact placement of my stop loss and where I place my TP, including the risk management strategies that I used. After watching this video, you will be able to use my strategy yourself in order to pass prop firm challenges and make consistent withdrawals with prop firms yourself as well. So make sure to take notes and let's dive straight in. We're here on the daily time frame on GBPUSD, and we're going to start by identifying the overall market structure or trend, because that's always the very first thing that you want to do. So what we had here was a high, a higher low, a higher high, a higher low, a higher high, and then here we have a lower low. So what happened here on the daily time frame is that we had a clear uptrend where the market was trending in towards the highs, but then what happened is that we broke market structure in towards the downside. So we have a clear break of market structure in towards the downside here, and we have now seen an overall impulsive phase in towards the downside, and we're now within a pullback phase. So the pullback phase here, I'm going to make nice and orange, and the pullback phase is a phase in where we're looking for potential longs as we're trading the overall pullback in towards the upside before the next overall impulsive phase in towards the downside will commence once again. Now, very important is to understand when these overall impulsive phases start, because the overall game that we're playing here when trading with this strategy is that we're trying to capitalize on those impulsive phases, because what we have here is, again, the impulse down, then we have the pullback in between, and then again we have the impulse down, then we have the pullback in between, which is again just the yellow zone, and then we have the blue zone again, which is the impulsive phase down. So I'm overall just looking to trade the impulsive phase down, but in order to trade that impulsive phase, you need two things. Number one, we need a liquidity high. So a liquidity high will always form within the overall impulse in towards the downside. So what I have as a liquidity high is, for example, this high over here, and my other liquidity high is this high over here. And liquidity highs can be very easily identified by looking for little bumps in the road within the overall impulse in towards the downside. Because once those little bumps in the road will get taken out, as we for example had over here, it's very likely that you can see a 250 pip drop, especially when it happens, for example, on the daily time frame. So when that liquidity first high gets taken out, we can see the initial pushing towards downside. However, there's not really a lot of momentum. You can see, okay, we break the low, straight away we retrace. Here we break the low, we don't even close below, and straight away we retrace. So by seeing that kind of price action, to me, it becomes very clear that the market still has some room to push up higher in towards the next liquidity high before then, for example, looking for the next sell in towards the downside. Now, the next piece of confluence that I want to explain to you guys is then also liquidity, because we've now identified liquidity in both instances. So remember, the overall confluences that we're now using is number one, market structure. So we understand that market structure is bearish. Number two, we look at liquidity. We understand that liquidity has been grabbed the first time, but it has not really been enough to continue pushing the market down lower. So there's still potential for it to push up one more time before then, for example, heading in towards the downside. Then we look at supply and demand. So when we look at supply and demand, we look at, for example, a buy before the sell. So what we have here at the top of the chart is, for example, this imbalance candle over here. Now, there are two ways that you can identify a demand zone. To keep it very easy and simple, we either look for a buy before a stronger sell in towards the downside. So for example, a buy up for a strong sell down, and you take the entire buy up before the sell as a supply zone. Well, as you can see here, price struggles within. Or we look at so-called imbalance candles. And there's a quick trick that you can use to identify these supply zones. It's called the 50% body candle by Emmy Nast. You can load in the indicator, and what you're going to be looking for are, for example, 2 or 3 or even 1 of these white candlesticks next to each other, and then they need to be engulfed in towards the downside, as we, for example, had over here. And then you can draw the supply zone from the lowest to the highest wick. Now, what happens there is that we then identify that as an overall area of supply. So we have that supply zone open, and we have that liquidity high positioned right below it. So what I'm now looking to see here on GU is a push in towards the upside before the next push then, for example, in towards the downside. So what I'm going to do now, or at least what I did back then, was something very risky. I took along within the overall impulsive phase, despite the overall market structure still being bearish, as I saw that there was an opportunity to gain around 130 pips in towards that liquidity high. So now when it comes to the actual execution of of the trade itself, I then went down to the 4-hour time frame. And for the 4-hour time frame, I use this indicator called daily, weekly, monthly, yearly opens by SBTNC. Now I load in the indicator, I double click, and I make sure that the 3 months is turned on, because that is a crucial level where I potentially want to be taking some profits. Now, what I identified at the time here on the 4-hour was that we had a clear break of structure in towards the upside. So here what happened is that we saw a break of structure, because after previously being bearish in towards the downside, we can clearly see that what I was explaining on the daily can now also be seen on the 4-hour, where market structure breaks in towards the highs, and now we could potentially see a retest and then an overall continuation further in towards the upside. What we can see is that this is an overall demand zone over here. And this demand zone has the potential to push price up higher, because remember, there are 2 ways that we identify demand. We look for a sell before a buy up, or we look for the imbalanced candles. Now here we have a perfect example of a sell before a buy up, breaking market structure, and therefore this is a valid demand zone. Now when it comes to those opens indicator, you always want to look for at least the monthly or the weekly, which are represented by an M or W, as key levels of support to push the market up higher. Now, when these levels align perfectly with an area of demand as we have over here, it is often a very good sign that a potential buy is coming into play. So what I saw here on GBPUSD on the 4-hour time frame was a beautiful play where we had another push in towards the downside. So we had an initial reaction over here to the highs, giving me the idea that initial buyers were coming into the markets. But then what happened is that the market retraced exactly back down in towards that monthly open, in line with the overall market structure. So again, if we look at the overall phase that we were in, we had the impulse up, then I was looking to time the next impulse in towards the highs. Now remember, what do we look when we want to look at the overall continuation trade? We need the liquidity, and we need the demand zone, and we need a change of character, also known as a change in the market structure. So what happens here is that the market structure shifted at the time after tapping into this monthly open. So we had a market structure break in towards the downside. You can clearly see here, push down, push up, push down. Now for this internal structure, I always focus on the most recent high that broke the low over here. And then what happens is that again, on the sell before the buy up, we form an area of demand. That for me is then the area where I want to enter with my stop loss underneath the lows. And then we target what? We target the overall liquidity high on the daily. So this was a very risky trade, again, in line with the overall pullback phase, but I was trading it towards that overall daily liquidity high and towards that 3 monthly open, which aligns again perfectly with a supply zone and with the liquidity high. And then from there, I was going to be looking for a longer term short position. So again, going back to the 4-hour time frame, this is a perfect pullback trade for myself. And what we can then see, so again, what we can see here is a demand zone. We have market structure in our favor. We have the monthly and weekly open supporting us in the form of support as they align beautifully with the demand zone. And we have a fractal structure shift, and we have liquidity. And then what happens is that the market taps us in, and then from there reverses and continues up higher in towards our TP. And then what you see happening, and this is not the trade that we're discussing in today's video, and then what we expect is that the overall pullback phase, which is again the overall orange zone, that is then over, and that the next impulse in towards the downside will start. Now again, how do we understand that the next impulse in towards the downside will start? Well, we can see here that liquidity gets grabbed, we tap into supply, we touch the open of the 3 monthly, and we see a what on the 4-hour time frame, we see a change in market structure in the form of here high break, low break, then what? The buy before the sell becomes your supply zone, and then that is where you could enter the short, which was in line with the impulsive phase for at least a 1 to 2 risk to reward. And then what you can see is that the overall next impulsive phase starts to commence and price starts pushing in towards the downside here on the daily time frame. So that's how I analyze the chart using 4 major confluences: market structure, liquidity, supply and demand, and of course premium versus discount. So when we look at premium versus discount, what I use is a Fibonacci retracement tool where I look, okay, has price at least retraced pretty much into the 0.5 Fibonacci retracement level. Now this is not a hard requirement, because what you will then often see is that price, when it has, for example, a demand zone open here, it will not always retrace in towards there. So what I use instead of the PVD tool to sometimes validate trades is the weekly, daily, monthly, yearly opens indicator by SBTNC, so then improve the overall win rate of my strategy and make sure that I do not miss out on such impulsive trade opportunities that come by. So thanks for watching, guys. If you have any questions, let me know in the comment section down below. There is a link to the free Discord in the description of this video. And additionally, I've created a free training explaining more about this strategy. All you need to do is click on the very first link in the description of this video. And again, thanks for watching and see you in the next one.